Did you know that $7.5 trillion of US government debt is coming due very, very soon? Because what have we seen happen over the past 2 decades? The US government has been on an absolute spending frenzy. Their deficits have been getting bigger and bigger, and right now they're at a $2 trillion deficit, which is set only to increase, and the debt is growing by $1 trillion every single quarter. And with the debt now nearly approaching $33 trillion, this is simply mathematically unsustainable, everyone. Eventually the road will end, and if the US empire keeps on printing money like crazy, like they've been doing, keep on taking on more and more debt, just as their credit rating has been downgraded, well, they'll end up with the same fate that Rome faced when they tried to dilute their currency as well. So everyone, exactly what is happening with the US government debt? Why is this going to be such a big problem when the $7.5 trillion worth of debt comes due? And what implications will this have for the markets, which definitely will be huge, and for you and me? Well, that's exactly what we're going to cover in today's video, everyone. So let's not waste any time. Let's get straight into the news, the facts, and the data. Wow, look at this, everyone. Again, this isn't clickbait. This is happening. 7.6 trillion of publicly held US government debt matures in the next 12 months. So what does this mean for the Treasury, and what should they do next, or what will they have to do next? Let's keep reading. Because look at this chart, everyone. 31% of all US government debt outstanding, or $7.6 trillion, will mature over the next year. Now, again, why is this so worrying? Because what they're going to have to do is they're going to have to issue more debt to repay this debt. This is going to flood the bond market with Treasury bills, and it's going to cause interest rates to absolutely skyrocket, which could cause something to break in the financial system, like what we saw with the repo market in 2019 when interest rates spiked to 12% overnight. So listen to this. Concerns about Treasury's increased issuance of T-bills and potential for volatility or market disruptions emerged following the debt ceiling fight in May. When angst over the government's ability to pay all its bills, it pushed yields above 7% on debt maturing in early June. So again, T-bills, they're like bonds. They're just more short-term treasuries that the government issues on a 1 month, 3 month, 6 month, or 12-month basis. And like what we saw happen in May when yields spiked over 7%, because there was all that drama on whether they're going to increase the debt ceiling or not. Well, imagine what would happen if they have to issue massive amounts of Treasury bills and government bonds to repay this debt that is coming due, or to recycle this debt. Well, we could see potentially the same thing happen with yields surging to 7% again, and cause, a lot of stocks in the stock market, they will simply plummet. We will see the cryptocurrency, that will definitely be affected. The precious metals industry will be affected. Pretty much all major assets besides cash will be affected if yields spike overnight. So even with modest coupon increases, the T-bill share of outstanding debt was expected to rise above 20% going forward. The top of the Treasury Bill Advisory Committee recommended range. So you can see, everyone, they're trying to issue short-term debt, long-term debt. They're pretty much looking anywhere they can go to issue more and more debt, but they're now starting to run out of places to go. Though the advisory group said it was comfortable with running a bit above 20% for some time, it is also recommended that Treasury take steps towards normalizing that level over time. So that's exactly right, everyone. While maybe they could handle it for a month or two, we know the path the US government is on right now. They're just going to keep on spending, keep on buying those votes, keep on sending hundreds of billions of dollars to Ukraine while the American people suffer. So I think this is going to cause a real issue, because they'll simply just keep on issuing more debt and they won't correct it over time like the committee is advising them. So the issue being raised by the TBAC is whether we're issuing too many bills and may have hit a critical threshold. Well, I think that's true. The real story is what treasuries will do next. This week brings 10 and 30-year auctions, and the market is going to have to digest more supply. So what is the Treasury going to do from there? Issue more long-term bonds or less? The minutes of the TBAC August meeting left the impression that the Treasury is leaning toward issuing more long-term debt, but we do have this other report that just came out. Because look at this, everyone. 3-year Treasury note auction draws highest yield since 2007. And did something bad happen after 2007? Oh yeah, that was the 2008 financial crisis. And guess what? If we do see the government issue too much debt and they flood the market with supply of these bonds, we're going to see interest rates spike even higher, and we could cause another financial crisis just like in 2008. So listen to this, everyone. The 44 billion sale was awarded at 4.66%, the highest for an auction of that maturity since before the financial crisis. So look at this chart, everyone. We can see here yields, aka interest rates on government debt, is skyrocketing, and this is going to lead to them having to issue more and more debt, and their interest costs are going to make up their biggest expense. So while traders still expect the Fed to lower interest rates next year, they're priced in a later start and smaller total amount of cuts in response to resilient economic data. Moreover, the scale of cuts would still leave the bank's benchmark rate well above the level considered neutral to economic growth. That's exactly right, everyone. Yes, even if they do not increase interest rates, they're going to leave interest rates on hold for at least another 6 months, and that's going to cause a lot of economic pain because we haven't felt the full lag effects of since when they lifted interest rates to their peak. I still think the economic data is only going to get worse over the next 6 months, and again, just them leaving interest rates right where they are right now is going to cause a lot of economic damage. And you know, it's actually not really a big thing what the Federal Reserve does with interest rates. It's more what happens to the 10-year US Treasury yield, because that's the rate what a lot of banks lend off. When the 10-year US Treasury spikes, we see mortgage rates go up, auto loans, credit card rates go up, etc. So even if the Federal Reserve doesn't lift interest rates, if the government issues more bonds, and at the same time the Federal Reserve and all other central banks around the world, and also governments around the world like China, Japan, are selling bonds, well, even if the Federal Reserve doesn't lift interest rates, they will go up. And people, if you think this is just all doom and gloom and it's not actually that bad, let me tell you, it's actually never been this bad in US history going back to 1787. Because look at this, everyone. Chart of the day. US Treasuries are on track for their longest stretch of losses since 1787. So make no mistake, people, the US government is in big trouble. So go ahead and bring up this chart here. We can see never in the history of the US Republic have Treasury returns fallen 3 years in a row. So we can see here they're down 17% in 2022. That was its worst return since 1788. And also this year in 2023, this is their third consecutive year of decline. So everyone, I know what you're thinking, well, okay, what does all this mean for you in simple terms? Well, what this simply means is the US government is in a lot of debt. They can't afford to repay it, and now they can't even afford to service that debt or pay the interest. So of course, what will the US government do to solve this problem? Issue more debt. Imagine if you had a credit card maxed out and you called your credit card company up and said, look, I can't afford to repay it, but can you just increase my limit and then I'll make the repayments with more credit card debt. It's absolutely crazy, everyone, but that's what the US government is doing. And who are the biggest holders of US government debt? Well, it's investors, hedge funds, BlackRock, it's banks. They hold all these bonds on their portfolios. You in your retirement funds, a lot of people hold government bonds in their retirement funds. So if they crash, this is going to cause a massive financial crisis. And again, simple supply and demand economics with central banks selling bonds, with government issuing more supply to the market, we're going to simply see prices fall and yields rise. Now, okay, what you're probably wanting to know is how can you protect yourself? Well, in the short term, even though I normally advise you want to have gold and silver, in the short term, if yields spike overnight, every single commodity, every single asset will crash. There will be a rush to liquidity. People will sell things off, ask questions later. And that's why you want to have some cash on the sidelines in case we do see something break in the next 12 months when all this debt comes due. So you can go ahead and take advantage of those opportunities. But everyone, what do you think about all of this? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.